The loan officer does not know you. She does not know that the late payment happened while your father was in the hospital, or what it cost to keep the rest of your life from falling apart that month. On her screen are 3 digits, 609. Another applicant has 681. Another has 742. Those numbers can decide who receives the mortgage and who pays thousands of dollars more to borrow the same amount. They look permanent, official, almost scientific. But in 1988, the familiar general-purpose FICO score did not exist. Credit scoring existed in fragments. Large retailers, finance companies, banks, and card issuers had been building their own systems for decades. But America did not yet have the portable financial identity we recognize today. One bureau-based number that could follow a person from lender to lender and turn years of behavior into an instant prediction. That arrived at the end of the 1980s. And when it did, it changed more than banking. It changed what Americans believed trust could be. So how did a country buy homes, open stores, finance harvests, and sell goods on credit before 3 digits could speak for everyone? The answer begins with a handshake. Then it passes through a network of secret correspondence, a damaging report that reached the Supreme Court, investigators asking neighbors how families lived, laws written after consumers discovered they could be judged by files they were not allowed to see, and 2 men who believed human judgment could be replaced by mathematics. To understand the number, we have to return to the world before it. Imagine a small American town in the early 19th century. A farmer needs seed in spring but will not have money until harvest. A family needs a stove before winter. A shopkeeper wants inventory that can be sold before the wholesaler must be paid. Credit is not a luxury in this world. It is the bridge between what a person needs now and what that person may earn later. But every bridge rests on one dangerous question. If I give you something today, why should I believe you will pay me tomorrow? In a small town, the answer was usually a story. The merchant knew your employer, your father, your church, your property, and perhaps the worst mistake you had ever made. If he did not know you, he asked someone who did. A respected neighbor could lend you part of his reputation. A merchant could forgive a missed payment because he knew a barn had burned or a child had become ill. Trust lived in human memory, and human memory could make room for context. That sounds kinder than a machine, but it was never equally kind. Personal judgment worked best for people already inside the circle of respectable men. A newcomer had no history. A poor family had no influential reference. A woman might be treated as an extension of her husband. A black applicant could be rejected before his finances were seriously considered. The same discretion that allowed mercy also allowed prejudice. There was no consistent rule to challenge because the rule might be nothing more than a lender's private feeling about people like you. And then America became too large for reputation to remain local. Railroads and canals connected distant markets. A New York wholesaler might receive an order from a merchant in Ohio whom he had never met. The Ohio merchant wanted goods now and promised to pay later. Sending a man hundreds of miles to interview his neighbors would cost too much and take too long. Refusing every stranger would suffocate trade. The country needed a way to send trust across distance without sending the lender with it. In 1841, a New York merchant named Lewis Tappan built an answer. His Mercantile Agency, described by the Library of Congress as America's first commercial credit rating agency, recruited correspondents across the country. Lawyers, bankers, merchants, and local observers quietly reported on businesses in their communities. Subscribers could ask about a distant firm and receive a description of its property, debts, habits, prospects, and character. For the first time, reputation was becoming a product that could be collected in one place and sold to strangers. The reports did not resemble today's clean digital profiles. They were handwritten judgments filled with facts, estimates, and gossip. A correspondent might note that a merchant was industrious, but overly ambitious, honest but slow to pay, wealthy through marriage, fond of speculation, or surrounded by unreliable associates. One sentence could decide whether a shipment left New York. The agency solved the problem of distance, but it created a new and more frightening problem. The person judging you might be invisible, and the judgment could travel farther than you could. John and Horace Beardsley learned how dangerous that could be. The brothers were merchants in Ohio. An inquiry about their firm reached Tappan's agency, and the answer contained explosive claims that the business had been sued, that property had been moved, that one brother's wife was preparing a divorce and alimony action, and that the store might close. The Beardsleys said the report was libelous and damaged their trade and credit. They sued Lewis Tappan. A private report intended for one commercial decision had become a public fight over who controlled a merchant's reputation. The dispute eventually reached the United States Supreme Court. The court's decision turned on legal questions about the evidence and ordered a new trial. It did not give history a simple verdict on every allegation. But the importance of the episode lies elsewhere. Decades before computers, Americans were already confronting the central danger of the modern credit system. A remote institution could preserve a damaging statement, conceal its original source, and influence people who had never met the subject. The database was still a ledger, but the power was recognizable. Tappan's agency eventually became part of Dun & Bradstreet. Its reports concerned companies and merchants rather than ordinary consumers, but the architecture of the modern system was now visible. Gather information from many places, compress a complicated reputation into a usable judgment, and sell that judgment to someone deciding whether to take a risk. That machinery would not remain confined to merchants for long. Then credit moved from the counting house into the American home. Cities expanded. Department stores offered furniture, clothing, and appliances on installment. Automobiles allowed families to buy a machine worth months of income and pay for it over time. A customer rejected by one shop could walk across the street and try again. Retailers began sharing information through local credit bureaus. The question was no longer only whether a distant merchant could pay for inventory. It was whether millions of ordinary households could be trusted with debt. These early consumer files were not scores. They were dossiers containing debts, payment experience, public records, and comments gathered by an investigator. Consumer reporting law still carries an echo of that era in the phrase investigative consumer report, information about character, reputation, or mode of living obtained through interviews. To a lender, those details promised a fuller picture. To the person inside the file, they could feel like a stranger had entered the home without opening the door. Picture a credit investigator arriving in a neighborhood where nobody knows why he is asking questions. Does the family move often? Do they drink? Is the husband steady? Is the wife extravagant? Do the neighbors consider them respectable? Some answers concerned the ability to repay. Others measured conformity to the social expectations of the time. A fact and a prejudice could sit beside each other on the same card. Once written down, both acquired the appearance of evidence. By the middle of the 20th century, that system was under enormous pressure. After the Second World War, millions of Americans wanted homes, cars, televisions, refrigerators, and new credit cards. Lenders faced more applications than personal interviews could handle. Branches in different cities needed to make similar decisions. A bank could not build a national consumer economy on the intuition of one man behind one desk. It needed speed. It needed consistency. Above all, it needed a way to predict the future from information about the past. In 1956, an engineer named Bill Fair and a mathematician named Earl Isaac founded Fair, Isaac and Company. Their idea was simple enough to fit into one sentence and radical enough to reorganize lending. Instead of asking which applicants looked trustworthy, study what previous borrowers had done and calculate which measurable traits best predicted repayment. Human judgment would not disappear, but part of it could be turned into points, weights, and cutoffs. The first systems were built for particular businesses. Stable employment might add points. Recent missed payments might subtract them. The balance between income and debt could matter. Different lenders chose different variables and different thresholds. According to the Federal Reserve, scoring began appearing in large retailers and finance companies in the late 1950s. By the end of the 1970s, most large commercial banks, finance companies, and credit card issuers were using some form of credit scoring. For a lender, the attraction was immediate. Two employees could look at the same application and reach different conclusions. A scorecard would at least force them to use the same rules. Decisions that once took days could be made faster. A company could test whether its rules actually predicted losses. And an applicant without the right close, accent, or social connections might succeed because measurable payment behavior mattered more than a loan officer's comfort. But these models were not yet one national score. A department store designed a scorecard from its own customers. A finance company built another for automobile loans. A bank might score an application using answers collected at the desk. The same person could be accepted by one lender and rejected by another, not because the facts had changed, but because the institutions asked different questions. The models were islands. What America still lacked was a common numerical language connecting the islands. There was another complication. Mathematics could standardize a judgment, but it could not make the data innocent. If lenders had historically excluded entire groups and neighborhoods, the surviving records already reflected those choices. A formula can be consistent and still consistently reproduce the world in which it was trained. The machine could remove the mood of one loan officer while preserving patterns created by generations of loan officers. Consider a married woman applying in her own name. She earns a salary and pays household bills, yet the creditor asks for her husband's signature. Her income may be discounted because the lender assumes pregnancy will end her employment. If she later divorces or becomes widowed, years of reliable payments may exist only under her husband's name. These were not rare misunderstandings. Women's organizations brought such patterns before Congress and demanded that creditworthiness be separated from sex and marital status. Black families faced a related trap. Redlining and discriminatory housing policy had restricted access to mortgages and homeownership, one of the main routes to both wealth and a long payment history. Removing race from a future scorecard could not manufacture the opportunities missing from an older file. The data looked backward, and the consequences of exclusion were already there. Meanwhile, consumers had almost no power over the files themselves. A person could lose a loan, a job, or insurance because of information held by an agency he had never heard of. He might not learn which statement caused the decision or who supplied it. Correcting a false entry could be nearly impossible. The industry had solved the lender's problem of knowing strangers. It had not solved the stranger's problem of being known incorrectly. That contradiction forced the system to change. The Fair Housing Act of 1968 attacked discrimination in housing. In 1970, the Fair Credit Reporting Act placed the first comprehensive federal rules around consumer reports. Agencies had to follow reasonable procedures for accuracy, limit reports to permissible purposes, and give consumers rights to see and dispute information. For the first time, the person inside the file had legal standing. The invisible ledger was no longer supposed to be beyond challenge. In 1974, the Equal Credit Opportunity Act made it illegal to deny credit because an applicant was a woman or because of marital status. 2 years later, Congress expanded those protections. Lenders still had to judge risk, but unexplained intuition was becoming harder to defend. Statistical scoring offered measurable rules across branches and applicants, while creditors increasingly had to identify real reasons for rejection. The age of private impressions was giving way to the age of explainable categories. This was genuine progress, but it carried a paradox. A model could recognize a reliable applicant whom a prejudiced banker might reject. It could also see a late payment without knowing whether it came from carelessness or a crisis. The system became impersonal partly because personal judgment had been unfair, then discovered that removing the person also removed context. Consistency and mercy were no longer the same thing. During the 1970s and 1980s, another transformation made a national score possible. Local bureaus consolidated. Paper files became computer records. Updates from banks, retailers, and other furnishers could be combined at enormous scale. A person could move from Ohio to Arizona without leaving every useful record behind. To lenders, portability meant a larger and more reliable market. To consumers, it meant a single error could move too. Imagine a wrong delinquency copied into a local card file in 1955. Its damage might stop with businesses that called that bureau. Now imagine the same mistake entering a national computerized system. It can appear for a mortgage lender, an auto dealer, a card issuer, and perhaps another decision maker before the consumer understands why doors are closing. Computers did not invent inaccuracy. They gave inaccuracy speed, reach, and memory. By the late 1980s, every required ingredient was finally present. National credit bureaus held detailed consumer histories. Computers could compare an applicant with millions of earlier patterns in seconds. Lenders had decades of experience with custom scorecards. Federal law constrained some subjective practices and made consistent reasons valuable. The mortgage and securities markets wanted comparable measures that could travel with loans. All that remained was to compress the bureau file into a number that almost any lender could purchase. Early bureau-based scores began appearing in 1987. Then, in 1989, Fair Isaac introduced the general-purpose credit bureau score that became the foundation of the familiar FICO system. This is the real turning point. It was not the first time anyone had used mathematics to judge credit. It was the moment a score derived entirely from a consumer's bureau record became a broadly usable product across lenders. The private scorecard escaped the institution that created it. The islands gained a common language. The score asked no neighbor whether you seemed respectable. It searched for patterns in payment history, debt, account age, and recent applications. It did not predict whether a person was good, responsible, or honest. It estimated the likelihood of serious delinquency over a future period. Yet the output appeared wonderfully simple, a position on a scale commonly running from 300 to 850. A statistical estimate began to look like a personal grade. There was never one official score stored in a government vault. The three major bureaus could hold different information, Fair Isaac could produce different models, and lenders could choose their own cutoff points. A mortgage company and an auto lender might see different numbers on the same day. The apparent precision concealed an ecosystem of data, formulas, and business choices. But to an applicant waiting for an answer, those distinctions did not matter. The number said yes, no, or yes at a price. The general-purpose score made the borrower portable. A bank could buy a standardized signal instead of building years of personal experience with the customer. Lenders and investors could compare thousands of mortgages without reading every family history. The person disappeared. The profile became portable. In the mid-1990s, Fannie Mae and Freddie Mac recommended credit history scores in underwriting mortgages they purchased. The score now stood near the doorway to homeownership, influencing how much families paid and how much wealth they might build over decades. Return to the three applicants at the beginning. The person with 742 may be offered a lower rate because the lender's model predicts less risk. The applicant with 681 may still qualify but pay more each month. The person with 6119 may need a larger down payment, accept expensive terms, or be rejected. Across a 30-year mortgage, a small difference in rate can become tens of thousands of dollars. Three digits do not merely describe financial history. They can change the financial future that produces the next score. This is where the strongest argument for scoring becomes visible. In the old system, a newcomer was financially anonymous unless someone important vouched for him, and a local officer could hide prejudice inside discretion. A standardized model could recognize a reliable payment record without caring about charm, family connections, or social status. It also allowed lenders to process applications quickly and approve some people who might otherwise be rejected simply because they were unknown. The number spread because it solved real problems. If it had offered no genuine improvement, it would never have become so deeply embedded. Now focus on the applicant with 619. Before her father's hospitalization, she had paid every bill on time for years. Then one medical crisis produced a late payment that revealed nothing about the nights in the hospital, the insurance dispute, or the choices her family made that month. The entry traveled into her report, and the score changed. A future lender saw a higher probability of default, not the crisis behind it. Consistency at scale can feel brutally inaccurate when a person knows the story, the data left out. And sometimes the data itself is wrong. A paid debt remains listed as unpaid. Two people with similar names are mixed together. An account created through identity theft appears legitimate. In a congressionally mandated study, the Federal Trade Commission found that 1 in 5 participants identified a confirmed error on at least one of their 3 credit reports. About 5% had errors serious enough that correcting them could move the consumer into a different risk tier and potentially change the terms offered. For the lender, 5% can look like a manageable imperfection in a system processing millions of decisions. For the person denied a mortgage because of someone else's account, the error is not 5%. It is 100% of the decision. This is the old Beardsley problem in digital form. A statement travels farther than its source. The subject must discover it, challenge it, and persuade a remote organization to change the record before the next creditor asks the database to speak. Then there are people the model struggles to see at all. A young adult may pay rent, utilities, and a phone bill without having much conventional credit history. A recent immigrant may arrive with years of responsible behavior that the American bureaus cannot read. A person who avoids debt may believe that never borrowing proves caution, only to discover that the system has little evidence from which to predict repayment. They are not necessarily risky, they are thin file or credit invisible because their lives have not produced enough of the data the model recognizes. The score also changes the behavior it measures. A person may keep an unwanted card open to preserve account age or borrow partly to prove the ability to borrow. Families monitor balances and time applications around effects they may not fully understand. Trust has become a performance measured by the rules of the model. That performance can become circular. Better terms make repayment easier, which can support a stronger future profile. Expensive credit consumes more income, leaving less room for error and making later difficulty more likely. A high score opens access to products that help maintain a high score. A low score raises the price of the second chance needed to rebuild it. The model predicts risk, but the decisions made from the prediction can help create the future being predicted. None of this means returning to neighborhood gossip would be better. That world was slow, secretive, intrusive, and often openly discriminatory. A handshake could contain compassion, but only if the lender was willing to shake your hand. The modern score emerged because each older solution had reached its limit. Distance created the credit agency, mass consumption created the consumer bureau, discrimination and secrecy produced federal protections, and computers allowed a national market to speak through one portable estimate. Each solution also concentrated more power in the record. A merchant's memory became a correspondence report. The report became a local dossier. The dossier became a national database, and the database became a score. The judgment grew faster and more consistent, but also more portable and harder to escape. Before 1989, Americans were already investigated, categorized, and scored. What they did not yet have was the familiar general-purpose bureau number capable of following them across the national credit market. If you want to understand the systems that quietly govern ordinary American life, subscribe. In the next story, we will enter another world before a modern institution existed and follow the problems that made it seem inevitable. Now return to the loan officer's screen. The applicant is still more complicated than 619. Her father's hospital stay, the paid rent, the family obligations, and every sacrifice the credit file cannot record still exist. But the lender needs an answer, and the score provides one both sides of the market have learned to obey. America did not remove judgment from lending. It moved judgment into data.